In this video, we're going to talk about how economists measure the production and output in an economy and how they use those measurements to determine economic growth. In macroeconomics, you're trying to study the economics of a whole economy, of the economy of a whole nation or a state or a region. And in order to do that, you need to have some macroeconomic aggregates. You need to have ways of counting things. And so the gross domestic product is the economic aggregate that we use to measure output, to measure how much is produced in an economy. And then if we look at it over time, we can determine economic growth. And so that's the first aggregate that we're going to cover, and we're going to review that in this video. There's also economic aggregates for labor utilization, the unemployment rate, and for changes in prices, the consumer price index, and those will not be in this video, but will be in other videos. But we start in macroeconomics with these economic aggregates because we use them over and over and over when we're doing macroeconomic work. So the gross domestic product is the economic aggregate that we use to measure output, to measure how much is being produced. And it's got a very specific definition. It's the market value of all final goods and services that are produced in a country in a given period of time. And that sounds pretty straightforward, but let's look underneath that a little bit. So first of all, we're using the market values of both goods and services. And we do this because we need to find some way to add together the values of things that are not alike at all. Apples and oranges, computer chips and potato chips, automobiles and cell phones. All these things have to be added together, and there's no real way to do it unless we use market values. And so when we're calculating the GDP, we're using the market values of goods and services. And so if we don't have a market value for something, then we really can't include it in the GDP. We use the market values. And also, we're looking at the value of the final goods and services, goods that are purchased for use by the final user. So intermediate goods are not included. Goods that are sold from one business to another business that are going to be used in a final product that's at some point. Well, those intermediate transactions are not included. We don't count those, and so they're not included. We do this because we want to avoid double counting. If we counted them at each step along the way as value was being added in the production process, we'd wind up counting the same thing many times, and we don't want to do that. So to get around that, we only calculate the values of final goods and services, and we don't count the values of the intermediate goods. In a way, we count the values of the intermediate goods in their final values. They're incorporated into the final product, and we count them that way. And this way, we only count them one time. And when we're talking about gross domestic product, we're typically talking about countries. We measure the gross domestic product for all of the United States, or for all of China, or for all of Brazil. Now, we can do it also for states or regions within a country. We can do it for all of the Americas or all of Asia. But normally, when we're talking about the gross domestic product, we're talking about what's produced within a country in a given period of time. And we, again, typically are looking at how much is produced in a given year. We could do it by quarter or by month. We could do it by decade, and oftentimes you'll see data for quarters or months and maybe longer periods of time. But traditionally, when we're doing this work, we want to at least make sure that we can count it on a year-by-year basis, and that's when you're doing macroeconomic work with GDP. Oftentimes, we'll be talking about 1 year versus another year. Now, with the gross domestic product, we're looking at the domestic production that occurs in a country in a given period of time. So the Toyotas that are produced in Tennessee are counted in the United States GDP, and products that are produced in Asia, maybe iPhones in China, would be counted not in the United States GDP because they weren't produced in the United States. So, based on this definition, we're looking at domestic production. It creates a few interesting anomalies. But the GDP measures production that happens within the country. And when we're doing GDP work, we're talking about the gross production. We're not taking any depreciation, wear and tear, things like that you might do in normal accounting and GDP accounting. We're just remaining with gross numbers. We're not taking into account any depreciation or wear and tear. And when we're doing the gross domestic product, when we're calculating the measurement, we measure the value of all the things that are produced. Well, it turns out that all the things that are produced happens to be equal also to all of the incomes that are generated in the economy. So the gross domestic product is equal to all the things that are produced in the economy in a given time period. It's also equal to all of the income that's generated, and all of the expenditures that are made from that income. So there's this equivalence between production and expenditures and income. And the Bureau of the Economic Analysis, which is part of the United States government, part of the Department of Commerce, is the group within the United States that measures and calculates and publishes all the data on the gross domestic product. And you can see on this website, the BEA.gov, if you go to that website, there's lots and lots of data, lots and lots of graphs and charts and tables. It's a great resource. They incorporate lots and lots of information, and they publish it in tables and graphs and charts to make it easily accessible to everyone. So there's two ways to measure GDP. We said before that we can count up all the expenditures that are in the economy. That's the expenditure approach. All of the things that are spent by consumers, all the investments that are made by investors, the government spending, and then net exports, and we add that all together. That's the expenditures approach. We'll come up with a number for the GDP in the economy. Well, we can also do it by adding up all the incomes, all the money that's paid in wages, all the money that's generated in interest, all the rents that are earned and profits that are earned. And whether we do it by the income approach or the expenditures approach, we should come up with the same number. And this is because firms pay out all of their receipts from the sales of the goods that they produce as incomes into these four buckets. And all of these incomes wind up being expended either by consumers or investors or governments or in imports and exports. So we can measure the GDP one of these two ways, using expenditures or with income, and whether we do it one way or the other, we'll come up with the same number. And again, this is because all of the transactions that are done by households and firms and governments and with the rest of the world through imports and exports add up to all of the incomes that are paid. And so we have this circular flow between incomes and expenditures. We can see incomes going in one direction, and we can see expenditures going in another direction. And the incomes and the expenditures are equal. And this is why we can calculate the GDP using either the expenditures methodology or the income methodology because of this circular flow. So let's focus on the GDP using the expenditures approach. We can take up all of the consumption expenditures made by consumers. This is for goods and for services in a given period of time, and we label that as C. for consumption. We then can look at all the investments that are made. This might be to purchase and build out new plants, new equipment, to build new buildings. This is done by businesses, by firms, for production. So they might make investments in new plants, new equipment, robots, buildings, all these things, all these investments are added up and labeled as I. And then governments also spend money. They buy goods and services. And so we can add up all the government expenditures that are made, all the purchases that are done by governments, and label that as G. Now, you'll note that governments will collect taxes, and oftentimes they'll spend money, but they'll also transfer money. But these financial transfers are not counted in the GDP. So money that is given to older folks as Social Security payments that are made to them, those are not counted in G. As a matter of fact, they're not counted specifically in the GDP numbers. So if an older person receives Social Security and they go out and consume or make investments and that kind of thing, that's where those expenditures get captured. So transfer payments made from the government, from that come from the tax base, and they go to different individuals in the economy. Those are not counted in the GDP. It's only the money the government spends to buy military equipment or legal services or security services or computers and things like that. And then lastly, firms are going to produce things, and sometimes they'll export them, and then of course other things will be produced in other countries and imported. And so when we're calculating the GDP using the expenditures approach, we take the value of the exports, things that were produced in the United States and sold elsewhere, and we subtract the value of the imports, things that were produced in other places and shipped to the United States. So this calculation is called the net exports. The exports minus the value of the imports is added. And when we do that, we add up all the consumption and investment and government spending, and then we add the imports but subtract the exports. For 2022, in the second quarter, when we add all that together, we come to $24,851,809,000,000. That's the GDP for the United States for 2022, if we're calculating it at the mid-year point in the second quarter of 2022. And you can see over time, this line here is the GDP. If we go back from 2022 back to 2012, it was about 2000. It was about 16 trillion, and go back a little farther, it's probably about half. So in the last 20 years or so, the GDP in the United States has doubled from about $12 trillion to about $24 trillion. And there's the overall trend is in kind of an upward slope of the GDP. This is you can see during the recession following the 2008-2009 financial crisis, the GDP was kind of flat and actually declined. And then this is the coronavirus pandemic, where we had the V-shape, the rapid decline, and then the rapid recovery. But the general trend is kind of an upward sloping line, where the GDP increases on average in each of the years. The economy is more productive in later years than it is in earlier years. Now, we can look at that 24 trillion, and we can see that most of it, about 17 trillion, is personal consumption, is C. And then we can see that the government expenditures, not counting transfer payments, is about $4 trillion. The amount of investment is about $4.6 trillion, so that's the second largest component. And then the net exports is minus a little more than $1 trillion. That means we imported about $1 trillion more than we exported. And so this is how the GDP breaks down. It's mostly consumption expenditure, there's a roughly the next largest items are the investment and the government spending, which were roughly equal, and then we have a negative net exports. We're importing more than we're exporting. And here's the detail. You can look and see underneath that the amount that was goods and the amount that was services, and you can see we have about 11 trillion of the 17 trillion dollars of consumption was in services. So we spend more on services than we do on actual goods, and you can see how much changed in investments. Here you can see the imports and exports. We exported 3.3 trillion. We imported, we exported 2.9 trillion. We imported a little more than 4 trillion. So there's the negative. We exported more than we imported more than we exported, and then you can see it breaks down, and all that is available on these tables that are at the Bureau of Economic Analysis website. So we can see lots and lots of data underneath it. We can see the subcomponents underneath it. So there is that $24 trillion GDP in the United States broken down into different categories. We could also calculate the GDP using the income approach. And because all of the expenditures that are made in the economy are paid for by income, and so the income in a given year should be equal to the expenditures in a given year. And when we do that, we have to add up all of the expenditures from wages, all of the interest that's paid, the rents that are earned, and the profit. And those are all the different sources of income, and it should come to the same thing. And you can see here that when we do that, there's some slight adjustments that have to be made because of the way that some of the incomes are bucketed differently, and there's some subsidies and depreciation that has to be subtracted and added. But again, we can calculate the GDP using the income approach just like we can calculate the GDP using the expenditures approach. And when we do that, you can see we come to roughly the same numbers here. For 2022, the data is not quite complete, but we get to the same numbers. And again, about half of the income is paid in wages, in incomes. And these are both to people who work as employees, and then also self-employed people and that type of thing. And then you can break it down and you can see how much is earned by corporations and how much is paid in rent. But the point here is that whether we do it with the income approach or the expenditures approach, it comes to the same number. Now, up to now, we've been talking about the nominal GDP, which is calculating the GDP using the expenditures or the income approach by using the market values for goods and services and the prices for goods and services in a given year. But we do know that the prices change from time to time. So we might have higher prices for the same amount of goods, and that if we're not careful, it would look like we've actually produced more when maybe we haven't produced anything else. We haven't produced anything more from one year to the other. Maybe just prices have gone up. And so in order for us to get underneath that and to understand, are we producing more, or is it just a situation where prices have gone up? We have to look at, we have this idea of real GDP. So in the nominal GDP is the production, the current quantities, and the current prices. The real GDP uses the current quantities, but values them at some sort of standard set of prices, or prices that are created during the base year. So when we value the prices from the base year, then we will be able to understand if we actually produced more, or maybe just the prices have gone up. So the base year is the reference year that we use. Now currently the reference year is 2012, and so when we're calculating the real GDP, we use the quantities from the current year, and we use the prices from the base year. So we describe the real GDP by using the quantities from the current year and the prices from 2012. Now this is a very simple example to show the difference between the nominal GDP and the real GDP. So if we look at 2012, and we look at a very simple economy with just some consumption, some investment, some government spending, you can see quantities. And again, this is a simplified example. If in the consumption there was 10 shirts at $20 and 3 factory robots at $250 and 1 set of security services at $100, well, when we multiply the quantities and the price and we add all that up, it comes to $10.50. Now, if we were trying to understand the economy today and we used the current year, this is 2022, amount of shirts and robots and security services, well, the quantities have changed. We've produced more in some cases and less in others, but the prices have changed also. Sometimes they're the same, sometimes they're higher. If we just calculated the nominal GDP for the current year, 2022, by multiplying the quantities times the prices, we'd come up with 2380 as the GDP. It looks like the GDP has doubled. But some of that increase is because we're producing more. Some of that increase is because prices are higher. So to calculate the real GDP for 2022, we use the quantities from the current year, and we use the prices for those same products or categories from the base year. And so now we get a different outcome. We use the 4 shirts from 2022 based on the 2012 price. That's $80. The factory robots are higher. It's now 4, and we use the prices from 2012 from the base year, and that comes to $1,000. And so you see, when we use the current quantities and the prices from the base year, we get a different number. Yes, the total value is higher. It's $1,280 instead of $1,050, but it's not quite as high as it was with the 2380. Why is that? Because we've isolated in by using the prices from the base year and the quantities from the current year just to isolate in on the changes in production, and we've factored out or eliminated the changes in prices. And so now when we look at real GDP for 2022, it's up, it's increased, but not by as much as it looks when we just do the nominal GDP. So the real GDP gives us a better idea for how much production has changed by removing or isolating or eliminating the changes in prices. And so, in fact, when we have the nominal GDP, we have the real GDP, which tries to move the effects of changes in prices. And there's a third type of GDP. It's called the chain dollar GDP. And you may hear about that. You may see that from time to time. And don't worry about how it's calculated. For our purposes, I'm not going to ask you to worry about how it's calculated, just to know that it exists. And in this case, it uses prices 2 years at a time. And so it calculates the increase in GDP in 2-year combinations, and this has an effect when the base year is a long time ago. In this case, the base year is 2012. It can make economic growth look larger than it is, and so the chain dollar attempt tries to look at growth in 2-year increments, and it tries to give us a more accurate picture of what economic growth might look like. Again, we have nominal GDP, which just uses the prices and quantities from the current year. We have real GDP, which uses the quantities from the current year and the prices from the base year to remove the effects of price changes, to remove the effects of inflation. And then we have chain dollar GDP, and that tries it's just one more way of trying to reduce some of the effects of price changes over time. Now, we can see here when we look at the chained real GDP, instead of being 24 trillion, it's 19 trillion. So again, this is backing out those changes in prices, backing out the effects of price changes from our real GDP calculations. And so at the BEA website, you can see nominal GDP, you can see real GDP, and you can see real GDP using chain dollars. Again, we're trying to be as accurate as possible to isolate and figure out how much are we producing more and how much more, but not be fooled by changes in prices and eliminate effects of changes in prices. So here is the GDP over the from 1950 to today, and this is using chained dollars. So these are the ones backing out the effects of price. And you can see a general trend that where the GDP is increasing over time on a nice straight line. Certainly there's periods of recession where the GDP goes down. This is the 1980s recession. Here we have the end of the dot-com boom, the 2008-2009 financial crisis. This is the pandemic. And so you can see periods of time where it goes down, but the general trend, the general line is for it to increase over time. And when we're thinking about economic growth, this chart kind of looks at a smaller period of time, the last 30 years or so. And sometimes the GDP is increasing, other times it's decreasing. In a large, mature, healthy economy like the United States, we should be in this 2 to 3% range. That's healthy economic growth. Here, this is, we can see us up in the high 4s. This is the dot-com boom. That's more unusual. Normally, we're in this 2 to 3% range, and that's considered healthy economic growth. Sometimes we have downturns. This is the 2008-2009 financial crisis, or after that, and we had negative growth. Here's the pandemic, where we also had negative growth. So sometimes it's more than 2-3%. Sometimes it's less. Might even be less than. Might even be negative. But on the whole, what we're looking for is economic growth in the 2 to 3% range. That's considered healthy economic growth for an economy like the United States. And here is just another way of looking at it. More recently, the real economic growth is generally growing in this 2 to 3% range. This was the pandemic, where we had a big big decline and then a big recovery, and then it goes back into the to stronger growth in that 2, 3, 4% range. In 2022, we had 2 quarters where it's down, 2 quarters of negative growth, and this is what we typically will say is a recession. If we have economic growth that's a negative 2 quarters in a row, then that's the way economists will define a recession. Now, the GDP is a composite number, and there's many, many pieces underneath it. So you can see even when the GDP is growing, or maybe it's growing faster or slower, certain parts are going to grow fast, and certain parts are going to grow slow. You can see that the changes that are contributing to growth, or not, certain things are growing more than others. There's more activity in the government sector, in transportation, in real estate, and we have less going on in durable goods manufacturing, less going on with construction and retail trade. And so the subcomponents, the parts that are growing or not growing, will change and depend over time. Now, let's look at the economy overall, or maybe the world economies overall, and we can see that in this presentation we focused on the GDP for the United States, and that's GDP is about 25.3 trillion, but we can really look at GDP for all the different countries and do depending upon what we're doing. So you can see the United States economy is 25.3 trillion. We have China over here, almost 20 trillion. China's been growing rapidly in the last 2 decades. They've been growing. This number's been growing rapidly in the 7, 8, 9% range. It gets harder to do that as your economy gets bigger, and so we can see that we have these different economies all around the world, and some are bigger, some are smaller. But in order for us to do anything with that, to make that meaningful, we want to look at the GDP of the different economies over time. We do that first and foremost to measure the amount of production in an economy and to measure the amount of growth. We also do that because we want to, if we can compare these over time, the GDP changes, well, we can maybe get an idea of how standards of living are changing over time. And then lastly, we may want to change, look at how standard of living are changing for different countries over time. In order to do this, to compare standards of living over time or to compare countries over time, we have to look at the real GDP per person. We have to factor the GDP for the amount of the population. Certainly, if we're comparing the United States in 2020 to the United States in 1960, well, there was twice as many people in 2020 as there were in 1960. We would expect an economy with twice as many people to produce more. The question is, how much more? And so in order for us to do this, we take the GDP at different time frames and we divide it by the population. We need to do this when we're comparing different countries. We wouldn't expect a country like Denmark with 6 million people to produce as much as a country like Brazil with 212 million people. Brazil is much larger population-wise. And so in all of these cases, whether we're comparing one country at different points in time or different countries at the same period of time, we need to look at the real GDP per person. We need to divide the GDP by the population in order to make any meaningful comparisons. And so when we do that for the United States, for example, between 1960 and 2012, we can see that the real GDP per person, after we've removed the effects of inflation, price changes, etc., after we've accounted for the fact that populations are different, the populations are bigger, is roughly 2.7 times. That means that the GDP in 2012 was 2.7 times what it was in 1960, after we account for inflation, after we account for population. So the average standard of living for the average person was greater in 2012 than it was in 1960 by a factor of 2.7 times. And so this is one of the ways that we use GDP. This is one of the ways that we analyze how GDP changes over time. Now, we can do that by comparing countries also. How has the GDP in one country changed over time relative to another country? Now, it's harder to do this across countries because they're using different currencies. And so when we factor in the different exchange rates, we'll get a comparison between the two countries. But economists aren't so confident with the comparisons we get by just looking at exchange rates because it oftentimes will distort the true differences between the countries. It'll make the differences look larger. And so we try to value when we're looking at one country versus another, we try to use purchasing power parity. It's viewed as a more accurate measure, and when we do that, the gaps between many of the countries will be smaller. And admittedly, using the GDP statistics with different products being produced, different monies, different exchange rates, it becomes difficult. So the purchasing power parity is the way that we do it, but even those comparisons we have to realize, have many challenges when we're making those comparisons. They're not as easy to make as comparing the GDP within a country in two different periods of time. But we do that all the same. One of the things we're trying to do with GDP accounting is compare countries over time. And so we use the GDPs between the different countries after we adjust for purchasing power as a way to do that. Now, we can also use our GDP statistics to try to understand if the economy is growing or not. Maybe the economy is not growing. If we have two quarters, two cycles, where we have negative, where the GDP is negative, where we have negative growth, well, in that case, we say that there's a recession has happened. And the economy is, instead of growing, the economy is shrinking. The GDP is lower if we have it two quarters in a row. So we use GDP accounting to help us understand when we have economic growth and when we have recessions. It helps us understand the business cycle. This is another reason that we do the the GDP accounting. Now, we have to understand also there's some limitations to the GDP calculations. There's things that we know, there's production that happens that are not included in GDP accounting. There's things that affect our standard of living that are not included in GDP accounting. So anything that happens outside of the market, maybe I'm producing things at home, I'm mowing my own lawn. My lawn gets mowed, but it's not counted in the GDP statistics. If I paid somebody to mow my lawn, well, then that will be counted. If I mowed the lawn myself, then it's not counted. So any do-it-yourself activity, any household production is just not counted in GDP. When we're calculating the GDP, and that's because a market transaction is not involved. This is also true with underground economic activity. If I pay somebody to do a job or or for a service or for products, and it's not done through official means, it's done in the underground economy, well, that doesn't get counted either. Now, one of the factors that affects our standard of living is how much leisure time we have. And so if we have a lot of leisure time, well, that's good for our standard of living, but it's not going to be accounted for in the GDP. And the same thing is true with environmental quality. We can produce a lot, but create a lot of pollution, and that's not a good thing, but it really won't show up in the GDP accounting. So there are some limitations to the GDP. Things that are done outside of the market, either at our home or in the underground economy, are not counted. Positive things like lots of leisure time that might happen in an economy are not considered. Only production is considered. If we're not producing because we have more leisure time, well, that makes the GDP smaller, but maybe that's not a bad thing. Same thing with the environmental quality. We may be producing a lot, but harming the environment, and that doesn't show up either. And economists know this. From time to time, economists have looked at trying to include these factors into the GDP accounting, because if GDP is some sort of reference point for high standard of living, for production, then we need to include these factors also. But they've struggled to really come up with another way of doing this. They've tried from time to time to include environmental quality or leisure time or non-market transactions, and really haven't been able to do this. And so the bottom line is that the real GDP is what economists use to try to understand production in the economy, to try to understand economic growth, to try to understand standards of living over time. There are issues with the GDP statistics. We know certain things are included, we know other things aren't included, and despite these issues, we use real GDP because it's the best indicator that we have about economic output and about economic well-being. And so, as you'll see with all these economic aggregates, we know that there are some flaws in the way they're defined. Maybe some things aren't counted, but we have to embrace them for what they are, because these are the best indicators that we have of economic activity. With GDP, in this case, it's the best indicator we have of economic production and of economic growth.